It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. Now, thanks so much for joining us. We are back with more Managing Your Financial Future, and lots of fun. More in the sense that we're continuing a discussion from last time, where we got into the whole idea of a Roth versus a traditional IRA. Professor Plum, that was a fun discussion. I hope everybody heard that.
And we could have gone a lot deeper, a lot further, a lot more expansive just on that topic. And now we're going to take it and add a whole nother layer of complexity to it and expand on it even further without talking about your 401k, which also can be either traditional or Roth in many cases.
Yeah, just asking the simple question that we asked on our last week's podcast, which was Roth or traditional IRA, how do you decide? It seemed like a simple question, and it seemed like perhaps a simple answer, which was, well, what's your tax bracket now and what's your tax bracket later, which is certainly part of it. But as we said, and as you pointed out, there are several layers of complexity just to that one decision.
Right, and now we're going to make it even more fun. And this is why I believe it helps to talk to a financial professional, a financial advisor who understands the different tax aspects, the different potential tax aspects. It's not all about taxes, though, necessarily, is it, Professor? Not necessarily. Some of it is flexibility, accessibility. What is it you're actually using this money, trying to save this money for? Some people use their early retirement savings accounts, Roth specifically, for uses other than retirement. And so why are we saving this money? Is it for when we're 59 and a half or older, 60, 70, 80, or is it maybe for a first-time home purchase? Might we need access? Might we need that kind of flexibility? And so that has some sway in the decision-making process as well.
So we covered the traditional versus Roth IRAs, at least on the surface, last time. So now we add the layer of a 401k. I'll say 401k, but I'm really talking about any type of retirement plan that you might have at work.
Any type of retirement plan that you have through your employment where you have the ability to contribute to it. A 403b, 457, a simple IRA, simple 401k, although I've never actually seen one created, even though they came out in 1998, I think, as well.
We've never talked about that.
Yeah, simple plans can be either 401k or IRA, and I've never seen the simple 401k.
Simple is an acronym, actually. It doesn't mean easy.
Yeah, it means savings incentive match plan for employees.
Match plan. The PL is part of the word plan.
Well, they had to make the acronym work for
it.
It
can't be simp plan. It just doesn't work. Plan, yeah.
But yeah, we're going to be talking about any kind of retirement plan offered through your employer where you can defer some of your salary into the plan, either on a tax-deductible traditional basis or maybe even in a Roth basis, like a Roth 403b, Roth 457, Roth 401k.
Are there Roth 457s too? Oh, interesting. Which I guess it makes sense. So when I say when I use the term 401k, I'm referring to any of those.
Basically any salary deferral plan offered through employment.
Exactly. So 401k I think are probably the most common, but teachers and
hospital workers, we're not trying to slight you.
We are not. So you understand if I say 401k for you, you can say 403b. Government workers, you can say 457. Although 457,
they could have 403bs too, some of them.
The government workers.
Some. But they also have the TSP.
Those are the
federal employee workers. But it's all the same idea. It's a retirement plan offered through your employer where you can defer some of your salary up to a certain level into an investment for your future, retirement.
Well, and that's where the 401k really comes into play here. 401ks have been around now since probably 74, 75.
I think
Again, I don't know if it had 70s. To do with the ERISA. Maybe it was 78.
Yeah.
Whatever it was, and the idea was...
it was before either one of us started in this industry.
Yeah, that's true. Long before.
And I've been in the industry for a while.
Yeah, I was high school, I think, at the time. But, okay, so 401k, you have an IRA. The government set those up. Those are called individual retirement accounts, IRA.
And that was an incentive, as we talked about last week. At the
to get
time,
you to save for your own retirement.
you get the tax deduction at the time for a traditional IRA and all that stuff. 401k, I mean, similar in many respects, I think, to
the traditional
401k
is similar in that you get a tax deduction for the money going in.
Mm-hmm.
It's tax deferred while you wait for it. It's taxable when it comes out. The bigger issue is the limit. Right now the limit for somebody who's under 50 is $6,000 for a traditional IRA.
That's per year. That's what you can contribute.
Yeah, it's $19,500 for a 401k. Assuming you make that much.
Yeah, $19,500. Big difference. And you have things like an employer match potentially and all that stuff.
And so but the retirement plan at work isn't necessarily all about you. And so, yes, you can contribute more to it, but there's also the possibility that if you contribute, the company contributes. And so the company is trying to incentivize you to save as well, not just the tax deduction from the government, but if they're doing what's called a matching contribution, where if you put in X, they'll put in Y, the company's trying to incentivize you to put money in as well. And the reality is, if they're matching you for what you're putting in and they're not doing anything or they're not doing as much if you don't put money in, that matching contribution is really part of your overall compensation. Don't give up part of your compensation. I mean, don't say, no, I'm only going to take 97% of my pay this year because I don't feel like doing this.
They've budgeted for you. It's up to you if you want to take it.
Right. It's your money.
My money, and I want it in
my account.
It's my money, and I want it when I'm 59 and a half or older.
Yeah, but I want it growing for me right now, so put it in my account. That's what a matching contribution. Now, there's reasons why the business will do that we don't need to get into, but that are anyway. But if they're going to match it, that's one of the deciding factors of, okay, I'm going to be able to save X amount of dollars. Where should I be saving that X? I have a traditional IRA, I have a Roth IRA, I have a 401k that they're going to match or not, and I have the option in many cases to do a Roth 401k. Now, the traditional 401k is fairly straightforward because we're used to the traditional IRA, tax deduction in, tax deferred growth, taxable coming out. What about the Roth 401k? Well, your contribution to the Roth 401k is very similar to the contribution to the Roth IRA. No tax deduction going in, tax deferred growth, tax-free coming out, living up to the 5-year 59.5 rule. But there's one other part to it. I mean, there's the matching contribution. But the matching contribution, if you have a matching contribution, it does not go into the Roth 401k.
It cannot go into the Roth.
The matching contribution from the company, if you choose Roth 401k that has a match to it, you will end up having a traditional 401k and a Roth 401k because the money that the company is putting in is going into the traditional side of the account. Mm-hmm. Why? Because you're not being taxed on it now, and they're getting a deduction for putting it into there. It's going into the traditional side because somebody got a tax deduction for it now. And so because somebody got a tax deduction for it now, it'll be taxable later.
Now, if you're wondering, should I do a Roth 401k or traditional 401k, you can listen to our discussion of the Roth versus traditional IRAs from last podcast. Right. Many of those results will be the same. And your company may not even offer a Roth 401k. Not all companies do.
Not all do, but more and more are coming online every day.
It's becoming
more mainstream.
Yeah, it is. So that may be something that you check into as well. The topic, of course, has to do with how should I invest in my 401k. Okay. And I mean, is this a function of age more than anything else?
Yes and no. There's two sides to the how should I invest my 401k. There's the money that's already in the 401k and the money that's going to be in the 401k through my salary deferrals over the next number of years.
The injections of cash that happened every 2 weeks or every month or whatever.
The current allocation and the future contributions. And when you're 25, the allocation should be the same on both. I mean, you're 25. You've got 40 years, basically, 35 years before really you can touch this. Use that for dollar cost averaging growth. use it to try to use the best potential return over a long period of time as you can. So your allocation will be fairly simple. Growth. My existing allocation and my new contribution should be growth.
Even if we started a bear market over the day you started your 401k.
Even better if you get a bear market over the next 10 years, so that you can be buying more and more and more and more. As a 25, even a 35-year-old, whatever, if you've got a long-term time horizon and you're just now starting saving, your future contributions, you put in $1,000 last month. Okay, if the market crashes, you got $500. In the long run, that's not going to affect you. But this new $1,000 you're putting in this month just bought twice as much as you bought last month.
There's a sale at Penny's. How many times do we say it? Absolutely.
You want so a younger person with no existing or very small existing allocation wants a down market for a long period of time to be able to buy and buy and buy and buy and buy and accumulate as many shares as possible and then have the market recover. An older person doesn't want to see that because they actually have money. Instead of going from $1,000 to $500, they go from $1 million to $500,000. That'll leave a mark.
Well, that will leave a mark, which is why kind of my question was, is this a function of age? If you have 35 years, 30 years, 40 years, whatever it is,
you can expose yourself to more volatility because you have the time.
Well, but let's say you're getting close. I mean,
so you're 55, 60.
Let's say you're 50. Let's say you're retiring at 65, and you're 10 years away. Is that enough time? Do I need? Does a 55-year-old really need to start looking at changing their? Let's say they've been aggressive their whole time.
Right. They've built up a nice nest egg. They've got a good account balance.
Yeah.
And now they're saying, you know what? What is more important to me? Is return or risk? And as you get into your 50s, later 50s, 60s, risk starts becoming more of a factor. And so the existing money, you start thinking about, let's maybe do some of that. Now, this also, we're assuming that all of the money is in the 401k.
Yes.
Because we have to look at the entire portfolio when we're dealing with how should the overall portfolio be invested. And so we could talk about, well, he's got personal money, he's got Roth IRA, he's got traditional IRA, he's got this 401k. Okay, that can get, which one should be invested? We're just going to assume in this case that all the money's in the 401k. And for some people, that's not too far from the truth because that's the only way they've been able to save and not touch it over these years.
Fine. Yeah. So much the better.
But as you get closer to retirement, whether you're 5 years out, 10 years out, it depends on how conservative or aggressive you're really feeling. And it depends on what's more important to me right now and how flexible potentially is my actual retirement date. If I have a drop dead hardcore date where I'm done at X, either because my licensing goes away or the company, it just
or I can't wait to get out or whatever.
Then you're going to probably want to start pulling back the aggressiveness when you're maybe 7 to 10 years out, 5 years for sure. And it has to do with when you start pulling the aggressiveness back, meaning you start taking money out of pure growth, moving towards more balanced and or even short-term bonds, or even a stable value fund, the G fund at the TSP and things like that. You've got to look at what is it that I'm trying to accomplish and where are we going? How much risk am I going to take? How much return am I going to take? So we're talking about the existing money though. I've got 500,000, 50,000, 100, 10 million, whatever the number is. I've decided that I need to pare back on my aggressive stature. And so I'm going to pull back $200,000 and put it in.
Because I'm maybe 5 years from retirement and it's...
or you've done your actual planning. You actually, and the plan says you should have this much here, this much there, and this much there. You do that allocation with your existing money. You do not change your future contributions to that same allocation.
And this is a very important point that you're bringing up, Professor, and it's one that I don't frankly hear a lot outside of this podcast, or I don't hear talked about a lot. So let's make this more of a concrete example. Let's say I was 100% aggressive growth stocks, and I've decided I'm going to retire at 65.
You're 60 years old now.
I'm 60, and I say, okay, that's too aggressive for me.
I can't handle, I've got $1 million in my 401k, and if the market goes down by 35%, I am going to lose my mind.
Right.
I do not want to see $650,000 there.
So I've decided to take what?
So you take, let's say you take,
of it?
300,000.
Okay, so 300. I'm going to. So now I'm going to take 300,000 of my million that's currently in my 401k, and I'm going to put that into something that's not volatile,
Right, or less volatile.
Or less volatile.
And in this, we're making this number up, but it's driven by your goals of how much money you need to withdraw, how soon you need to withdraw, and things like that. But in this example, we're just saying, so now we're going to have a 70-30 overall mix between the aggressive and more conservative.
So 700,000 of my
stays aggressive,
stays in the aggressive, and 300 is somewhere which is less aggressive.
Let's assume you're even more conservative and you go 50-50. You've pulled 50% out of the aggressive nature and you've put it across the board in other areas. And so that, because of your goals, that's the allocation. But you're still working. Mm-hmm. You're still contributing as a 50-plus-year-old individual up to $26,000 a year into the account. And the company is still matching at some level, if they're matching at all.
Let's say I'm putting $26,000 in. Let's just say that. A nice.
Should that be split 50-50? My answer is no. That should be going to the aggressive side. Your dollar cost averaging. In some respects, you want the market to go down a little bit so that your new money going in can buy that many more shares. You've taken care of the risk with the existing money by allocating half of it based on your plan to a safer area. So you've got time horizon for that money. And the money you're saving, you're 60 years old, you're going to retire at 65. The money you're saving today is not for when you're 66 or 67. It's for when you're 77, 87, 90, maybe 107.
If you live that long.
But that's, you take care of your existing allocation. If I put in $1,000 and the market goes down by 30%, okay, I went from 1,000 to 700. But if I leave my existing assets available, invested for growth, I went from $1 million to 700,000. Which one leaves a bigger mark on your psyche? I mean,
no question. And this, see, for everybody listening to this podcast right now, this is a very, very important point. And we used to talk about this when we did our TV shows and our radio shows. Same kind of a thing. See, for 30 years, I'd been putting my money, because I was 100% aggressive growth. Let's say I put 26,000 in a year. Well, I couldn't have done that.
Whatever the limit was.
Whatever the limit. I'm just going to say, let's pretend it was, let's say it's 26,000 a year. I'm used to putting that in. The money goes in every year, 26,000, and it spreads out over my entire 401k because
your entire 401k was invested for growth.
Right. So now that I'm in our made-up example, I'm 50% aggressive growth and 50% something
more stable
something. I've still got $26,000 going into this per year, going into this 401k. What you're saying is that $26,000 should not be spread out, the
way my
13,
existing assets.
Yeah, it should not go 13 into the aggressive growth and 13 into my less volatile side. You're saying direct that entire 26,000 this
or whatever
year,
you're putting in
to
the growth.
Put it all into the aggressive growth side, and don't add.
You allocate to the safer stuff. You don't dollar cost average into the safer stuff. You don't systematically average.
Your new money
should not be going into the safer stuff. You get no benefit from it.
It should only be going into the go get 'em aggressive.
As I said, the money you're saving today, if you're 60 years old, retiring at 65, or you're retiring in a couple of years, even if you're 64 and you're retiring at 65, the money you're saving today out of your paycheck is not for 66. It's not for the next 15, 20, 30 years. It's money for the future, the long-term future. So take advantage of that dollar. And you're saying, well, I'm just going to roll it to an IRA in a couple of months, couple of years. Fine. It's a lateral transition. You've already set your plan up. You've set your appropriate allocation up in your 401k, given the choices that they're giving you. When you ultimately roll it to an IRA, if you do that, it's going to follow the same allocation in the IRA. You just may have more choices.
And keep in mind, not everybody should roll their 401k into an IRA. I want to mention that. That's something that you got to discuss with your advisor, because we've talked about that before. But this is all for illustrative purposes.
Yes.
This is a hypothetical situation. How many people know that that's usually potentially a better way to go? To direct all the new money
to the growth orientation.
To the growth side, and don't put any new money into the non-volatile, non-growth side.
use existing capital. You safen up existing capital.
You don't add
dollar cost average to that side.
And again, you don't do it because what you're saying is dollar cost averaging into a...
Well, dollar cost averaging needs volatility to work in your favor. Exactly. It needs the market to go up and down and over time recover.
Otherwise, it's not really doing any good.
You're not getting anything out of it. If it's always, like a money market account, if it's always $1 a share, all I'm earning is that 0.0% interest right now. Okay, so maybe you got 0.5%. But you don't have anything else working for you. With the volatile side, now the market does need to recover at some point, and so that's why you need a longer term time horizon. But you need to know that the money going in today is not for tomorrow. It's for 20 years from now. Now you have an appropriate time horizon. You want that volatility. You want to, I watch mine just because I watch mine. I want to see what's happening. And
I do too.
But I never know exactly what day the contribution's going in.
I don't either.
But I sure, the market goes up, 0.5%, down 0.5%. It's up and down every day. Mm-hmm. I want that contribution to go in when it's down. And so I'll take losing a little money on my other growth assets to be able to buy more shares, knowing that I still have 10, 15, 20 years with that growth part of my 401k.
Oh, and let me tell you, if you have 15 years, the buying the cheaper shares now is
hopefully cheaper.
if it goes up over that period of time, over that 15 years, it makes a difference.
Oh yeah, you want that dollar cost averaging working for you, doing it into the safer side of the volatility spectrum. Yes, you're saving, which is it's better than not saving, mm-hmm. but you're not getting any help. And we all need a little help. Saving is not the easiest thing in the world. Earning, understanding how to make things work as efficiently as possible as we're trying to do.
Now this sort of leads into the withdrawal section of financial planning, taking money out. You've made less volatile half of your 401k in this hypothetical example. We've made this less volatile. So when it comes time to take money out of that 401k,
when it comes time to change direction mm-hmm. of money.
Once you retire, you hit 65 and you're done.
We're putting money into, we want the volatility so that we can buy more shares when the market's down. That is just to turn around and reverse the order when you retire. You do not want to take money from a volatile area. You want to take, the reason we put money there was so that we would have the distribution we wanted for a period of time to buy time for that aggressive side of the portfolio. So if you're dollar cost averaging in and all you do is turn around and take it from the same source, a volatile source, it's called reverse dollar cost averaging. As dollar cost averaging uses the volatility to your advantage, reverse dollar cost averaging is the exact opposite. That volatility hurts you because if the market goes down and you need to get 1,000, 10,000, whatever the number is, this month I have to sell a lot more shares than I did last month. Now those shares aren't there and they can never recover.
And you're saying you never want to be in that position.
In any situation, you do not want to be in a position where you are forced to sell an asset just when the market is down. And you never want to be put in that position where you have to sell something because of a market condition. Now, there are times where you're going to sell some stocks because they're down because they stunk and you picked the wrong stock. Okay, that's a different issue. But we're talking about markets where the market goes down, your portfolio goes down. You don't want to be in a position where you have to sell from that down market area. You want to be able to draw from an other area that has no or very little market correlation so that I know that if I need $10,000 to live next month, I've got $10,000. I don't have to sell what was $12,000 worth of stock to get my $10,000. And because that means now $12,000 is not there to recover. You want to leave the stuff that has volatility alone, which means you need to have safer, distributable principal and interest on another side. That's why we put that in this hypothetical example, 50% in safer money.
Yeah, because when it comes time to withdraw, you only want to take from that non-volatile
right. And as that non-volatile side comes down, you're looking for opportunities. We've built in a long-term time horizon for that growth asset. We've tried to protect ourselves from what the market does daily, weekly, monthly, maybe sometimes even over a couple of years, where it can go down. So we've set up an area where we can outlast the market's misbehavior. But that doesn't mean that the market always goes down. The market goes up too. And so we look for opportunity to take profits that are over and above what we expected to get out of the market. Maybe we expect a 10% rate of return out of the market. And so in our example, we had 500,000 in the market. We expected it to be 550,000 at the end of the year. And lo and behold, it did really well. And it's at 600,000, whatever number. That's when you look to take advantage of that excess profit and pare back, maybe refill some of that money you've spent out of bucket number one. We call it bucket number one.
Yeah, what you're doing is reallocating your 401. We're talking about your 401k.
Right.
We're talking about reallocating now.
We're talking about the 401k, but in reality, we're talking about your entire portfolio.
It is your entire portfolio. But yes, this is but you can do this with your 401k too. You can reallocate that if the money is still in your 401k at this point. You can move it over to the side. So that's existing money.
What you've done, though, is you've tried to protect the growth money by having a long-term time horizon so it can recover. And you also are looking to take opportunities, positive opportunities, when you're doing your withdrawals. Now let's look to see when that thing gives us an opportunity to take some profits. And let's not be too greedy. Unfortunately, a lot of people see the market going up and they start pulling from the safe side to invest into the market. Now, when the markets are going crazy, let it ride. For a retiree, I'm talking about. Let it ride. And every once in a while, take some of the excess profits and refill your spending bucket.
Yeah, you're not going to get horribly rich doing it that way, but the idea behind this is to protect you because you don't know when those downsides are going to happen.
Well, I would say that you're probably not going to miss out on a lot because of a couple issues. For one thing, you tend to be a more sophisticated investor in that you don't get panicked and sell when the market's down. You actually look at that as an opportunity of where can I find some cash to put in. But by doing it this way, you don't let the market dictate your reaction. And so you become less reactionary. You don't sell when the market's down because you're afraid of losing your portfolio and losing your actual cash flow. And so you're more apt to let the market recover, which in turn lets you be smarter, quote unquote, investor during that time.
So when I go back to the question of 401k allocation, I asked earlier in the podcast, is it a function of age? And you had said it is in many ways.
Existing capital.
Existing capital. When you're young and you've got 30 years, whatever it is, don't worry about what the market's doing. You don't need this money for 30 years.
Right.
35 years,
20
40,
years, 15
20,
years.
Whatever it is. You've got time. As you get closer to retirement, you want to start
reallocating your existing capital within your 401k to more closely match your goals and objectives and your strategy.
And the key there is, as long as you're still working and you're still contributing to your 401k, take your
growth.
new contributions and only direct them to the growth side.
Yes, sir.
Don't let them hit the volatile side, non-volatile side, because you're getting really no benefit.
You're getting no help.
You're getting no help. Yeah, you're saving
you're getting a benefit by you're accumulating assets, but you're not getting any outside help.
And then once you do retire, once you've hit your retirement age, and you're going to start withdrawing your money, at that point,
have an appropriate withdrawal strategy which says don't withdraw from volatile areas.
Right. So just as when you were working and you're directing your contributions only to the volatile areas, when you're no longer contributing and you're taking money out, now we
don't take any money from the volatile area, which is why we created that safer area.
And that's really kind of part of the bucket strategy. We talked about 401ks, but this applies kind of across the board to your entire portfolio, as you said.
Yeah. We're using the 401k as part of like a little microcosm of the whole.
Well, that's what it is. That's
when you get the whole portfolio involved, it's like somebody gets a new job at 60. How should they start their 401k? Their existing capital is zero.
Yeah, that's true.
And their new contribution should be all growth because they have other assets to fill the other portions. Now, if you're 60 and this is your first savings, you've never had the opportunity to save before. I could argue that you still need to be more growth oriented because it's going to be a couple of years. You're not just working there for 1 year. You're going to be there for 5, 6, 7 years. Mm-hmm. You don't have the luxury, unfortunately. You have to build a portfolio.
Yeah, and you may be working a little longer than you thought, but that's
unless you have good pensions and this is just a side job with it.
That's true. That's true. This is all part of the financial planning process. This is what happens. This is what financial advisors like Professor Plum and the advisors at Lucia Capital Group look at. It's a big part of the planning 401ks, of course, are, as you said, a microcosm, Professor. But this is all a big part of the whole planning process, is it not?
Well, it's where is the money going to come from? And so, yes, understanding 401ks, IRAs, contributing to IRA versus 401k. How do I invest each one of them? Yeah. What is the ultimate goal? Because there may be a different goal. If I have traditional IRA, if I have Roth IRA, traditional 401k, Roth 401k, I may have different goals for each of those piles of money because of the way that the life is set up. And so what are my goals, and how do we align each of the investments within the accounts to match what our goals are?
You want to talk to Professor Plum? Well, really any of the Lucia Capital Group advisors, because they all work under Professor Plum's watchful eye with each and every plan. Give them a call, 800-644-1150. If you're wondering, hey, I've still got 15 years to retirement. Should I still be aggressive growth? Well, maybe, maybe not. It's going to depend on your goals and your individual situation.
And your ability to handle risk.
Well, that's all of investing, I think, probably comes down to that question as well.
Yeah, there are some that shouldn't be in growth because they know, or at least they've experienced, or they feel that when the market drops, they're going to sell. And that's going to be hurtful.
It is. And part of there's a psychological aspect of financial planning.
That's what I'm talking about here.
Yes, being a financial advisor can be, they can be the ones that tell you know what, for your risk tolerance, you're taking too much risk.
Or for your goals,
cases.
You're taking too much risk.
For your goals, you're taking, yeah.
I ran into that last week where the people have the ability to have twice the amount of income they've set aside, they've determined as their retirement goal. And they're only 3-4 years from retirement, and they're still 100% equity, 100% growth. It's like they're taking way more. Now, their ability to do it is they can do it because they have so much extra money. But do they really want to take that much risk?
Well, and that is going to come down to the individual investor again. Are you investing? Maybe you're not investing for yourself at that point. Maybe it's for your heirs 30 years from now, in which case, maybe that's okay.
Yeah, but you got to know that.
You got to know that. You talk to the advisors, 800-644-1150, Lucia Capital Group. That's what they do. They do this every day. They do this all the time. It's just part of financial planning. 800-644-1150. You can also go online, LuciaCap, LuciaCap.com, and you can get in touch with them that way. Check out our videos online. You can also subscribe to this podcast, Managing Your Financial Future. You can do that over at Spotify. We get a lot of new subscribers every single week, and we'd love to add you to that list. If you haven't done so, go over to Spotify, and you can get these episodes downloaded directly to your listening device each and every week. And we upload new episodes just about every single week. So that's about all we have for today. My thanks to Professor Plum, Certified Financial Planner Professional. Next week, do you remember what we're talking about?
No.
Pensions. This has
lump
to do lump sum versus annuity.
Okay.
Again, we're talking about ways to maybe potentially get.
How do you plan for it? How do you work it into your overall strategy?
Exactly. So tune in for that next week. Even if there are some people who don't have pensions, but it's still good information, because how do you plan to make sure that if you're married, your surviving spouse gets exactly what you want? How do you make this legacy?
I'd have
continue?
to win the lottery for my surviving spouse to get exactly what I want her to get. I don't have that set aside yet.
No, you don't. No, and you may never.
No, not by that strategy for sure.
No. My thanks to Professor Plum. I appreciate it. For him, and I'm Johnny Dean. I'm your podcast host, not an advisor, but again, enjoy hanging out with these guys because they're so smart, I would say. Thanks so much for listening. We will talk to you again next week. This has been Managing Your Financial Future. Talk to you soon.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy, including the investments purchased and/or investment strategies devised by LCG, will either be suitable or profitable for clients or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the presentation or any component thereof serves as the receipt of or a substitute for personalized advice from LCG or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution or RMD in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. A dollar cost averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities regardless of fluctuating price levels, you must consider your willingness to continue purchasing during periods of high or low price levels. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. It is important to keep in mind that investments in fixed income products are subject to liquidity or market risk, interest rate risk. Bonds ordinarily decline in price when interest rates rise and rise in price when interest rates fall, financial or credit risk, inflation or purchasing power risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government, but are subject to inflation risk. Stable value funds can be viewed as an alternative to money market funds. However, there are important differences, and stable value products can be complicated. Unlike money market funds, stable value funds are typically not registered with the SEC. In addition, they are not guaranteed by the U.S. government. The structure of or investments within stable value may vary, and it is important to consider these differences in selecting a stable value fund. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties and, if taken prior to age 59.5, may be subject to an additional 10% federal tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Information on investment products is for informational purposes only and does not constitute an investment recommendation or a solicitation to buy or sell the investment products described herein. Any investments or strategies referenced herein do not take into account the investment objectives, financial situation, or particular needs of any specific person. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.